If I sat you down right now and asked you this simple question, why aren't you investing yet? Some people might say it's because they feel overwhelmed and have no clue where to start. Some people might be confused about what to invest in because they hear a million different pieces of financial advice. And some people might not even know the type of investment account to open. And then there are others who are just a bit nervous about putting their hard earned money into the market instead of keeping it in a bank account. All of this is completely understandable because when you first start investing, it genuinely feels like you just got dropped in the middle of a completely different world that you're just trying to navigate your way through. And honestly, it can feel very overwhelming at first. You know that movie Jumanji where they just get dropped off in the middle of the jungle? That's pretty much how I felt when I first started. I was like, what the hell am I doing? What tends to happen, and this is exactly what happened to me at first, is that you get a spark of motivation to start investing. Maybe you stumble across some of my videos or read a couple of investing books, but then you get right up to the point of actually taking action, and then you back off because it doesn't quite feel like you're ready yet. And it feels like you're missing some sort of critical piece of information that you just can't figure out. And the problem with that is the last thing you want to do is delay investing because every day you sit on the sidelines, you're missing out on compounding interest working in your favor. So I wanted to make a longer video that actually walks you through the basics of investing. I'm going to cover everything from how to open your first investment account to breaking down the common terms that get thrown around with investing. I'm going to talk about what you should actually be investing in, how to build a strategy that makes sense for you, and I'm even going to touch on the psychology behind investing and how to handle it over time. This is going to be, again, one of my longer videos, but I think it's incredibly important for those of you who are new to investing to stick around to the end because my goal here is to make this an all in one, straightforward guide that actually helps you get started investing. I know I would have appreciated a video like this if I had come across it at 22 years old, so I hope you guys get a lot of value out of this. Let's get into it. Before we even talk about where to invest or what accounts to open, we need to take a step back and clearly define what investing actually is. Because I think a lot of people hear that word and immediately think it's something complicated, when in reality, it's a lot more straightforward than it seems. Investing is simply taking your money and putting it into businesses that have the potential to grow over time rather than letting your money sit in a bank account. Or, like the old days, just stashing your cash under your mattress. When you invest, you are essentially buying small ownership in these companies. And I'm going to hit you with another movie reference here. It's kind of like in The Dark Knight when Bruce Wayne walks into that restaurant. The waiter asks him where he wants to sit, and he basically says anywhere because he owns the place. As funny as that sounds, that's literally what you're doing when you invest. You are owning a piece of the business that you're putting your money into. Even if it's something like 0.00001% of the company, you still have ownership. So when you hear someone say they're investing in the stock market, all that really means is they're putting their money into businesses and allowing that money to grow as those businesses grow over time. Now, the reason this matters so much is because if you're only saving your money and not investing it, you're actually going backwards in terms of how much that money can buy because of inflation, which is just the gradual increase in prices over time. Inflation has been higher over the last few years, but historically it averages about 3% per year. So even though your bank account balance might be going up, what that money can actually buy is slowly going down every single year. And that is something that a lot of people don't fully realize yet, which is exactly why investing is so important if you actually want your money to continue growing. Investing is how you combat inflation. And more importantly, it's how you start building real wealth over a long period of time. Because when you strip all the noise away and focus on the fundamentals, investing isn't about getting rich or making risky bets. Investing is about buying into long term growth of the economy and giving your money the opportunity to compound and grow over time while also outpacing inflation. So now that we've covered the basics of what investing actually is, the next step is figuring out how to actually open your first investment account and get money into it. Because this is usually where people get stuck and start overthinking things. However, I think this is one of the easiest parts of investing as a whole. The first thing you need to do is choose a brokerage, which is basically just the platform that allows you to buy and hold your investments. And there are a ton of solid options out there like Fidelity, Charles Schwab, Vanguard, and even Robinhood, which I personally don't love, but I can't deny their user interface is actually pretty clean. The good news is that you really don't need to stress too much about picking the perfect platform because they all accomplish the same goal, which is giving you access to invest in the first place. So the biggest thing here is just picking one and getting started rather than sitting around comparing every little feature. I do recommend doing a little bit of homework beforehand and maybe watching a couple of videos on the interface of these different brokerage platforms and the different features they offer. But don't spend too much time on this because at a certain point, you're just procrastinating. Once you pick a brokerage, the process of opening an account is very similar to opening a new bank account, where you'll enter in some of your basic personal information, you'll link your bank account, and the whole process usually takes maybe like 10 to 15 minutes max if you just sit down and do it. Obviously, you have to be at least 18 to open your own account, but beyond that, it's pretty straightforward, and these platforms will walk you through everything step by step. Now, when it comes to what type of account to open, you're typically choosing between something like a Roth IRA or a standard taxable brokerage account. A Roth IRA is a tax advantage account where your money grows and can be withdrawn tax free in retirement, but the trade off is that you generally can't pull out your earnings without penalties until around age 59 and a half. Whereas taxable brokerage account is a much more flexible account and allows you to invest and access your money at any time without restrictions. The downside there is that you'll owe taxes on your gains and dividends, so it is not a tax efficient account. I usually point people towards opening a Roth IRA first because you'll want to take advantage of that tax free growth and compounding, especially when you're younger. And you can always open both accounts or just start with one depending on your situation. You can even have a Roth IRA in one brokerage platform and a taxable brokerage in a different brokerage platform if you want. And after your account is open, the next step is actually funding it. And this is where you just connect your bank account and transfer money over, which is very similar to moving money between a checking and a savings account if you think about it. And most platforms will give you the option to do a one time transfer or set up reoccurring transfers so the money automatically moves into your investment account on a schedule. So when you break all this down, opening and funding your first investment account isn't some complicated process. It is just picking a brokerage platform that you like, opening the account, linking your bank, and moving some money over. And once you've done that, you've officially taken, I think, the biggest step that most people never get past, which is actually getting started. Now that you've actually opened and funded your first investment account, the next step is figuring out what to actually buy. And this is where I think a lot of people also start to really overcomplicate things because there's so many different options out there. However, once you understand a few basic concepts, this part becomes a lot more simple and honestly a lot less intimidating. So, starting at the very basics, when you hear people talk about stocks versus ETFs, all a stock is you buying a piece of a single company. Remember, I talked about ownership earlier in this video? A singular stock is just buying ownership in that singular company. So, if you go out and buy something, let's say like Apple, you are putting your money into one specific business, and your performance is tied directly to how that one company performs. Whereas an ETF, which stands for Exchange Traded Fund, is essentially a bundle of a bunch of different companies all packaged together into one investment. So instead of having to pick just one company to invest in, you're buying a collection of companies all at once, which gives you instant diversification and reduces your overall risk. Now, there's always trade offs to either option. Buying individual stocks has a lot more potential upside than ETFs, but it also has way more downside because that one company that you choose to invest in can either be the next Nvidia that give you crazy returns, or that one company that you decide to invest in could go bankrupt and out of business in the next year. You just have no idea. Now, ETFs provide more diversification, but you won't have as much potential upside. Me personally, I only invest in ETFs now because I don't want to spend my time researching individual companies and taking a risk that the one company I choose to invest in goes underground and underperforms the broader market. I personally just don't want to put my time and energy into that, so I stick to ETFs. But it is totally up to you and your risk. Now, when you go actually buy one of these investments, you're going to see something called a ticker symbol, which is a short abbreviation for that investment. So instead of typing out the full name of a fund or the full name of the company, you'll just type in something like VOO or SCHD, and that pulls up the exact investment or ETF that you're looking for. That's how you actually place the order to actually start investing. Another thing you might notice is that a lot of these ETFs or stocks can be pretty expensive per share. And that's where fractional shares come into play because instead of needing hundreds of dollars to maybe buy one full share of VOO, which is around $630 per share at the time of this recording, most brokerages now allow you to invest with whatever amount of money that you have and buy a fraction of one share. So if you only got 50 bucks or 100 bucks in your account, you can still get started investing without needing all that money up front. You'll also hear something called dividend reinvestment, which is basically when the investments you own pay you a small portion of their profits back to you in the form of a dividend. And instead of taking that cash and going and spending it, you can actually automatically reinvest it back into buying more shares of that exact same stock or ETF, which over time additionally helps accelerate the compounding effect. Another important concept to understand is something called an expense ratio, especially when you're looking at buying into ETFs. And this is just a very small fee that the fund charges you annually to manage your investment. And most of the broad market ETFs, this fee is extremely low. Usually something like 0.03, anywhere from 0.03 to like 0.10. But it is still something you might want to be aware of because the higher the fees go, the higher they're going to eat into your overall returns over a long period of time. Think about if a fund had like a 1% fee and you made $1 million off it. That would be $10,000 that you don't get in your pocket. That's why you got to be careful with the mutual funds and your 401ks. And I would just do a double check on the expenses that you are paying for your investments. Now, when it comes to what I personally invest in, I like to keep things very simple and focus on a few core ETFs. And the main ones I buy are VOO, SCHG, and SCHD. And the reason I like this combination is because it gives me a good balance between overall market exposure, growth, and income. And for these, I'm talking about overall market exposure for the United States. I'm not investing in international ETFs at this moment. So VOO tracks the S&P 500, which is essentially the 500 largest companies in the United States. So that gives me a broad exposure to the overall market. SCHG focuses more on growth companies. So this is where you're getting more exposure to companies that are expected to grow at a much faster rate. And then SCHD is more focused on the dividend paying companies, which adds a layer of income and stability to the overall portfolio. So instead of trying to pick individual stocks and constantly guessing which company is going to outperform the S&P 500, I'd rather keep things simple. I'd rather stay diversified and consistently invest into the ETFs that give me exposure to a large portion of the market. Because over the long run, that strategy has proven to be very effective for me without requiring me to consistently monitor or stress about every little movement in the market. And now that you understand what you're actually investing in, the next step is figuring out what is your investment strategy. And just as importantly, understanding the psychology behind investing. Because this is the part that really determines whether you're going to be successful over the long run or not. And it has a lot less to do with picking the perfect investments and a lot more to do with how you behave with those investments over time. When I talk about your investing strategy, what I really mean is having a clear plan for how you're going to consistently invest your money. You need a clear plan with how much you're investing and what you're investing in, and how much you're going to stick with the plan regardless of what the market is doing. The biggest mistake I see with people is they're constantly changing their investment approach because they're reading a new news headline, they're reacting emotionally, they see the dips in the markets and then react even more emotionally. A good strategy doesn't need to be complicated. In fact, it's usually better if your investing strategy is simple. Something like consistently investing a set amount every single month, maybe into a few diversified ETFs, and letting that strategy run its course over decades and decades. This is where something like dollar cost averaging comes into play, which is just a fancy way of saying you're investing consistently over time instead of trying to time the market. Nobody knows what the market is going to do in the short term, and trying to guess when to get in or out of your investments just usually ends up hurting you more than helping you. By investing consistently and dollar cost averaging, you remove that guessing game and you take advantage of both the ups and downs of the market over time. Now, on the psychology side of things, this is where people either make or lose a lot of money. Because when you see your portfolio going down during the market pullbacks or downturns, it is very easy to feel like you're doing something wrong or that you should just pull your money out to protect it. But those are often the worst times to sell because you're just locking in losses instead of giving your investments time to recover. That's why having a solid foundation, like an emergency fund that covers 3 to 6 months of living expenses, and a clear investment plan is so important because it gives you the confidence to stay invested even when things get a little bit uncomfortable. And it prevents you from making emotional decisions in moments where the market is super volatile. The people who tend to do the best over time are not the ones consistently jumping in or out of the market. So don't fall for that bait on social media. The people who are successful are the ones who stay consistent, stay patient, and stick to their investment strategy even when it doesn't feel great in the moment. So when you think about your investing strategy, it just needs to be something that you can realistically stick to for years. Because at the end of the day, investing is a long term game, and your ability to stay consistent and manage your emotions is going to matter so much for you. So that's all I have for this video. If you enjoyed this investing 101 video, give this video a like and comment down below, what are you investing in this year? As always, thanks for the support on this channel, and I'll see you all in the next one.